Straight to the Archegos. It knocked 5 billion Swiss francs off the value of Credit Suisse last week. The provisions are in. Is this, in your mind, a demonstration of excessive risk in the market or just incompetence in risk management? And is there more to come?
I think it's a combination of the two. We're in a situation where financial markets are extremely frothy. We have either zero policy rates or negative policy rates in advanced economies. In spite of a pickup in long rates, financial conditions are very easy. And we're seeing widespread frothiness, bubbles, and restaking and leverage. This is the phenomenon you see with the cyclically adjusted P ratios now being at levels they haven't seen since 1929 or 2000, when there was a bust of bubbles. We've seen now this frothiness in other financial markets, the SPAC phenomenon, the crypto phenomenon, the blow up of some hedge funds. So I think there is generalized frothiness as money is very easy, liquidity is very easy, and people are taking too much risk.
So if you think this is what the environment is calling for, do you agree with Scott Minerd then that there's going to be more family offices or hedge funds that could implode?
Oh, yeah, I would agree with that assessment. I think there are lots of players that have taken too much leverage, too much risk, and some of them are going to blow up.
The kind of risk adjustment, Nouriel, in terms of the blow up, what could happen to equity markets? What's going to cause these equity markets, as you say, the froth to come off?
Well, I don't think that a single institution going belly up is going to cause that. This is not a situation like 1998 when you had a huge, highly leveraged hedge fund like LTCM went belly up and had systemic effects. But I think that the markets probably are starting to worry about these overheating of the economies coming from this Fed and Treasury experiment. We have massive fiscal stimulus. We have massive monetary stimulus. There's a risk that the economy is going to be overheating. There is a risk that inflation expectations are going to be rising. The Fed says we're not going to end QE until next year. We're not going to raise rates until 2024. So the short end of the yield curve is anchored, but the long end of the yield curve can go higher. Markets are expecting that the 10-year may reach 2% by year end, but what if it's going to 2.2, 2.3, 2.4, and you have a rise in real yields? That could be the shock that actually hits equity markets in US and globally.
We're talking about a spike in yields. Where do you see inflation, Nouriel, going? And do you think it's only going to be a blip, or is it here to stay?
Well, in the short term, we still have slack in goods and labor markets and in commodities. But if you're looking over the next 2 or 3 years, we have still large monetization of fiscal deficits in US, in Europe, in Japan, throughout advanced economies. And I fear that we're going to be observing a series of negative supply shocks that may lead then to inflation and then stagflation. We have deglobalization and the rise of protectionism. We're going to see tension between US and China escalate and increase decoupling on trade, in finance, in technology, in data and information. We have aging of population in advanced economies and emerging markets, and therefore the supply of labor is going to be restricted. We're now going to go to policies that try to reduce inequality and the weakness of labor. We're going to be taxing capital, among other things. So there are many things that may reduce potential growth, increase the cost of production, and then in a situation in which you monetize fiscal deficit, eventually you could have a de-anchoring of inflation expectation and a rise of inflation well above the targets of central banks. The Fed is saying we're going to tighten when inflation is above target, but we're in a situation right now where there is a huge amount of private and public debt. And central banks that are going to try to raise rates when you have too much private and public debt are at risk of causing a financial crash. And I worry that they've lost their independence, and we've been choosing between raising rates and causing a financial crash, a recession, or accommodating and then leading to a rise in inflation well above target. Maybe the latter is going to be more likely than the former.
Nouriel, you are assessing the fiscal stimulus that's coming. We're waiting to see what infrastructure stimulus we get. You talk about an on-anchoring of inflation expectations. With the stimulus that is on the table and proposed, do you think it's excessive? And do you think it will on-anchor the inflation expectations?
Well, we did 3 trillion plus last year. We just passed 1.9 trillion. The current infrastructure and also human capital investment plans may be another 4 trillion in an economy that is already recovering quite robustly. So I think by certain standards, the fiscal stimulus is likely to be excessive. In part, it's being monetized by the Fed, and this combination of very, very aggressive fiscal, monetary, and credit stimulus and easing over time can lead to an overheating of the economy and the anchoring of inflation expectation. That's certainly a risk that both Treasury and the Fed are underestimating, but is a rising risk.
The upcoming package is, of course, the infrastructure, $2.25 trillion. Is tax hikes the right way to pay for it, Nouriel?
Yeah.
Yes, because from a fiscal point of view, the situation of the United States is unsustainable. Public debt as a share of GDP is rising sharply. We also have implicit liability coming from unfunded Social Security, Medicare, and healthcare system. So both explicit and implicit debt is very high, and eventually that's not sustainable. If you're looking over the rise of the next few years, we see very large budget deficits for as far as I can see. So we have at some point doing something about it. We're not going to be able to cut spending, so we have to increase taxes. And whether you like it or not, taxes on the corporate sector are going to go higher. Taxes on the wealthy, on the rich are going to be going higher. The question is, what's going to be the market implication of a significant increase in tax rates in the United States?
Where will that play out, Nouriel? Will that hit equities? And you talk about the deficits. We might waken up to the deficit situation, perhaps not now, but will that knock the dollar? Put some context around those two markets for me on what you've just said about the deficit situation.
Well, for now, the markets are going higher because they believe that the growth impact of the stimulus and infrastructure is going to be dominant. And I think that probably the tax increases are going to be postponed in terms of being introduced by early next year. Even if they're legislated this year, they're not going to be backstopped. But eventually, I think the market is going to start to worry about what's the implication of corporate tax rate going from 21 to 28%, a whole bunch of loopholes to be reduced, having capital gains tax as ordinary income for wealthy people, the marginal tax rate for highest income individuals going to 39.5%. In New York State, they're also raising local taxes and so on. So I think the markets are going to start to eventually price in this, and there's going to be an impact. On the US dollar, recently, the slide of the dollar has been stopped because U.S. growth is outperforming the one of Europe. But if you're looking at the medium term, we're running very large twin current account and fiscal deficit. Those deficits are going to become larger as our fiscal deficit becomes bigger. Lower public saving means a larger current account. And now you don't have the capital inflows to backstop the dollar because now the Fed is saying zero rate QE for as far as I can see. And finally, another weakness of the dollar is going to come from the fact that the U.S. is using the U.S. dollar as a tool of national security and strategy and using sanctions against strategic rivals. And these strategic rivals, whether they're China, Russia, Iran, North Korea, wanting to diversify away from dollar assets and from a dollar funding system. So if you're looking at all these factors, I would say that the dollar will gradually weaken over time, even if in the short term, growth outperformance of the U.S. is strength in the dollar. The direction of the dollar is south over time.
Nouriel, we just talked about as well the corporate tax rates. Overnight, we heard from Janet Yellen talking about a harmonized corporate tax rate around the world. Is that really realistic?
Well, you know, the Brits are already deciding with a conservative government to raise also the corporate tax rates. I think that the phenomenon is that on one side, we need to deal with these budget deficits. We're not going to be able to cut spending, so we're going to have to raise taxes in part. And there has been a massive increase in income and wealth inequality. You know, in the United States, 81% of the equity wealth is held by the top 10%. 51% is held by the top 1%. The bottom 50% of the distribution of income holds 0.5% of the wealth. You have 50 billionaires in the US who have more wealth than the bottom 165 million people. So whether you like it or not, there'll be increasing taxation and taxation of the wealthy, of the rich, and of the corporate sector. That's a direction we're going in the US, in Europe, and other parts of the world.